Welcome to the SMSF Property Pathway. I'm Jason McCall, the SMSF Property Guy. For over 12 years, I've assessed property damage as an insurance claims manager and assessor, but now I use that exact experience to physically stress test blue chip A grade SMSF properties for high income professionals. If you have a super balance over 250,000 and you're tired of watching it sleep in a retail fund while you work 60 plus hour weeks, you are in the right place. On this show, we strip away the industry noise, expose the ATO compliance traps, and show you how to build up to $100,000 plus tax-free retirement income without sacrificing your weekends. Before we dive into today's episode, please hit that subscribe button, give this video a like, and make a comment below and share it with a colleague who needs to wake up to their super. Let's get into it. I spent 12 years as an insurance claims expert and assessor, tearing apart defective homes, and 6 years as a deck foreman on the docks here in Melbourne. I watched shift workers trade their physical health for superannuation, only to leave it sitting in lazy industry funds. Here is why I built the SMSF Property Pathway. Look, that's not a line I wrote for a podcast. That is my life. And today I'm going to take you inside it, because until you understand where I came from, you won't understand why we reject 99% of the properties that we actually look at. And you definitely won't understand why that 1% is the only thing standing between your retirement and a gamble. 6 years down on the wharf in Melbourne as a deck foreman. Now, if you've never worked on the docks, let me paint this picture for you. Container ships, big gantry cranes, steel, concrete. The noise never stops. The shifts don't stop. You're working rostered shifts, days, nights, weekends, public holidays. And the men and women alongside me, well, they were hardworking, gritty. They give you the shirt off their back. They were sparkies. There was fitters, riggers, stevedores, dogmen, guys who traded their knees, their backs, their shoulders, their physical health for a paycheck. And for what? For superannuation. That was the deal. You break your body now, and the super takes care of you later, right? Well, that's what they believed and I believed. And I watched it firsthand every single day, every single week. These men and women pouring their sweat into a system that was supposed to have their back at age 67. Here's the bit that used to eat at me, because even then, before I knew anything about SMSF strategy, I could see the flaw. All that money, all that sacrifice sitting in an industry fund, a pooled fund, doing nothing, earning whatever the fund decided to return, minus its fees, minus the taxes, and minus the drag of everyone else's underperformance in that same pool. They were the CEO of nothing, passengers of their own financial journey, and they didn't even know it. Now, here's where it gets very interesting, because before the wharf, I spent 12 years in the insurance industry, specializing in claims, and in particular as claims manager and also a property assessor. My job was to walk into homes after disasters, floods, fires, storm damage, and figure out what was really going on. Not what the owner said, not what the builder's report said, what was actually happening behind the walls and under the floors, inside the structure. And let me tell you something, I saw some things. I saw homes that looked perfect from the street, fresh paint, new kitchens, polished floors, the full renovation. And behind that fresh paint, cracked stumps, rising damp that had been travelling up the internal walls for years, subfloor rot, termite damage, and that had been painted over, not treated. Structural movement that had been concealed, not fixed. I know exactly where hidden property damage lurks behind all that fresh paint. That was my job, to find what the spruikers didn't want you to see, to tear apart the illusion, and I did it for 12 years. 12 years of opening up claims reports, pulling up floors, checking every structural component from the roof to the walls to the floors to the footings. 12 years of learning exactly how a bad property is dressed up to look like a good one. And that was experience. That's not theory. That's not a course I took. That is scar tissue that's embedded in me. That is thousands of hours of physically walking through damaged properties and documenting what I had found. So think about this. 6 years on the Melbourne Wharf, watching hardworking people sacrifice their bodies for super that sat idle. 12 years as an assessor and insurance claims expert, watching how a bad property can destroy a family's finances from the inside out. 2 careers, 2 sides of the same coin. The problem, hardworking Australians putting their retirement capital into something that they can't control, whether that's a lazy fund or a lemon property. And the solution? Well, the SMSF Property Pathway, a system that takes your sleeping super, puts you in the CEO driver's seat, and then critically makes sure that the property you buy isn't going to blow up your retirement from the inside. Because buying property inside an SMSF is not like buying in your own name. If you buy a lemon in your personal name, it hurts. If you buy a lemon inside an SMSF, you're not just losing capital, you're potentially triggering a 45% non-compliance penalty from the ATO. That's not a slap on the wrist, that's catastrophic. So the property has to be right. It has to be bulletproof, and that is where the 155-point stress test comes in. Now, stick with me because this is the most important part of this entire episode. When we source a property for a client, it goes through 2 filters, 2 completely separate layers of defense, and both of them have to pass, no exceptions. Layer 1, the empirical formula. Before we even look at a specific property, we assess the market it sits in. And we use what I call the empirical formula because empirical evidence relies on practical experience, not theory. Not a gut feeling, not a spruiker's promise, hard data. E is for economy. Must be strong and diverse. Single industry towns, we walk away. Is for market size. A minimum of 50 house sales in the past 12 months. Thin markets are dangerous markets. P is for population. The local government area needs a population above 15,000. Population drives demand, and demand drives growth. I is for infrastructure. Good existing amenities, evidence of major new projects, hospitals, schools, transport, real investment, not promises. R is for rental market, low vacancies, upward pressures on rents, because if the property sits empty, you're bleeding. I is for increasing employment opportunities, evidence of jobs growth locally. People go where the work is. And C is for capital growth, strong potential within 5 years. We're not speculating on a 10-year maybe. A is for affordability. Medium house prices between 600 and 700,000. We want upside. We don't want the peak. And L is for low risk. We avoid volatile markets that present high risk to consumers. Full stop. Empirical. 9 criteria, every single one backed by data from platforms like Hotspotting and Stash Property Data. Not opinion, but evidence. And if a market doesn't pass all 9, we don't even start looking at properties. It's already gone. That eliminates a massive chunk of Australia. And layer 2, well, that's our 155-point physical stress test. This is the microfilter, the one that separates us from every spruiker who will sell you a property over a Zoom call from 2,000 kilometres away. If a market passes the empirical formula, then I personally fly interstate or locally. I do not buy sight unseen. Do not outsource to local agents who have a vested interest in you buying. I get on a plane and I walk that property myself, and I take my 155-point physical stress test with me. This is where 12 years as an insurance assessor and claims expert becomes your unfair advantage, because I don't walk through a property the way a buyer's agent does. I walk through it the way a claims assessor does. I'm checking the footings, the subfloor, the drainage, the roof cavity, the internal walls for signs of movement, the external cladding for water ingress, the site contour for flood risk, the council overlays for anything that could bite you 5 years from now. 155 individual checkpoints, and if a single one raises a red flag, we walk. Not we negotiate, not we get a discount, we walk. And that is why we reject 99% of everything that we look at. Now, let that sink in. 99%. That means out of every 100 properties we assess, one makes it through. The other 99 are rejected, and they're rejected for a good reason. hidden defects, overinflated prices, flood zones we caught on council overlays that you cannot see on a virtual tour, structural issues behind fresh paint. The list goes on and on. This is not a rejection rate to be embarrassed about. This is a rejection rate to be proud of, because every property we reject is a potential disaster we just saved you from. See, the Spruker model is volume. Sell as many properties as possible to as many people as possible, sight unseen, over a Zoom call or a video walkthrough, and then move on. They don't care if the property has a cracked foundation. They don't care if it sits in a flood overlay. They care about the commission. I care about your retirement. And when your retirement capital is inside an SMSF, buying sight unseen isn't a shortcut. It's a gamble. And you're not just gambling with property values. You're gambling with your entire retirement and potentially triggering a 45% ATO penalty on top. That's why I fly. That's why I walk. That's why I drive. And that's why we reject 99%. Now, I get asked this question constantly. It came through again this week. What is your 99% rejection rate guarantee? So let me answer it directly. The 99% rejection rate guarantee is exactly what it sounds like. We reject 99 out of every 100 properties we assess. We only present you with the 1% that has passed both the Empirical Formula macro filter and the 155-point physical stress test micro filter. Zero red flags, zero compromises. Why? Because drawing on my 12 years as an insurance claims expert, we run every single asset through a ruthless physical inspection. If it has a single red flag, structural, compliance, locational, anything, we will walk. We reject 99% of properties to ensure your capital only lands in that top 1%. And that's the guarantee, not a discount, not a concession. That's rejection, because rejection of a bad property is the highest form of protection for your capital. Exactly what goes into the 155-point stress test, the criteria checkpoints, the red flags we look for. I put together a free download. It's called the 155-point SMSF Property Stress Test. This is the actual framework my team uses when we physically walk a property. Not a summary, not a sample, the real document. Grab it by leaving a comment, stress test, in the comment below. And if you're even thinking about buying property inside an SMSF, you need to see this first, because those perfect photos won't ever show you a cracked foundation. Well, that's it for today's episode of the SMSF Property Pathway. Remember, buying an investment property sight unseen is a coin flip. Doing it inside an SMSF is a catastrophic risk. You cannot save your way to $100,000 retirement income. Only leveraged property can help you there. But you also shouldn't have to sacrifice your weekends to manage complex ATO compliance. If you're a high-income professional couple ready to step into the CEO seat of your super, click the link in the description to take our 60-second SMSF property readiness assessment. We'll show you exactly what is possible for your specific super balance. If you found value in today's episode, please hit that like button, subscribe to the channel, and share this with someone who needs to hear it. I'm Jason McCall, the SMSF Property Guy. Protect your fund, and I'll see you in the next episode.